Hello and welcome to our finance mini-series. I'm Dr. Robert Clark and today's video is on capital structure. Capital structure is really an essential concept in finance and particularly for businesses. It refers to the combination of debt and equity that a company uses to fund its operations. In simple terms, it's the combination of the ways that a company raises its funding. The principle of capital structure revolves around two key components, being debt and equity. Debt represents the funds that a company borrows from lenders, while equity is the money that a company raises by issuing shares to investors. The combination of these two sources of funding form that company's capital structure. An important facet of capital structure is the concept of leverage. Leverage refers to the degree in which a company relies on debt financing relative to its equity financing. Companies that use more debt financing are said to be highly leveraged or heavily leveraged, while those that rely more on equity finance, I guess we could say they're relatively less leveraged. Now, this is important because the degree of leverage can have a significant impact on the company's financial performance, on its return to its equity investors, and most importantly, on its risk profile. Now, I'll be discussing the cost of capital in more detail in another video, but basically the cost of capital is the return that a company must earn on its investments to satisfy its investors in lending. The cost of capital is both important when considering a capital structure, but the cost of capital is also influenced by a company's capital structure. For example, a company with a high degree of leverage will generally have a higher cost of capital than a company with a low degree of leverage. A third principle of capital structure is the concept of an optimal capital structure. The optimal capital structure is the perfect combination of debt and equity financing that maximizes a company's value. This is the capital structure that minimizes the cost of capital while balancing the risks associated with debt and equity financing. Achieving an optimal capital structure requires careful analysis of a company's financial situation, of its balance sheet, of the market conditions, etc. A quick example may be a family-run business, purely equity financed, owns some prime property, and they're considering taking out a competitor. They need to raise funding. Do they sell more? Do they bring in more shareholders? Do they sell more equity? Or do they tap that cheap funding that they can secure against their property? In this case, the optimal capital structure may include some of that cheap debt financing. Another important consideration of capital structure is the impact of taxes. Just quickly, debt financing is generally tax deductible, which means that those corporations that use debt financing can reduce their tax liability and increase their after-tax profits by deducting the cost of that debt financing. Equity financing, on the other hand, is not tax deductible. As such, the tax advantage of debt financing is an important consideration. Also, a capital structure should be flexible. It should allow for flexibility in adapting to changing market conditions and changing business needs. This may involve adjusting the balance sheet between debt and equity, as well as exploring alternative sources of funding, such as convertible bonds or preferential stock, which are effectively a combination of debt and equity financing. Me personally, I find capital structuring incredibly interesting for this reason, right? A company that relies heavily on debt funding will have a lower cost of capital. Just assume that it's not being pushed to the edge. It will have a lower cost of capital, so a smart use of debt will increase the return to the equity holders. However, the paradox is that the more debt you use, that the higher your debt ratios are, the more risky your company is. So this goes to the heart of the optimal capital structure. What gives you the best return? without risking the company by using excessive amounts of debt. Thank you for being with me here today. Please subscribe, and we'll see you in the next video.